Welcome to the deep dive.
Okay, so today, let's move past, all the noise around chatbots. We're diving headfirst into the physical side of AI, where things actually move, lift things, weld things. Wall Street's obsessed with LLM, sure, but the real infrastructure play, the one hitting maybe, $130 billion by 2035, that's happening in robotics, and our sources are pretty clear. The really critical infrastructure for this physical AI wave, it seems to be controlled by three giants, but they're all taking fundamentally different paths. We're talking Tesla, Amazon, and Nvidia. And it's fascinating when you unpack that $130 billion figure. Our research shows industrial robotics, the traditional arms, the conveyors, that's projected to climb to about $94 billion. But the real shakeup, the part-grabbing headlines, is humanoid robots. Goldman Sachs actually tripled their forecast for that specific bit. They see it hitting $38 billion by 2035.
Wow, tripled.
Yeah, that's the big shift, like a tectonic plate moving under the whole market.
Okay, so that kind of jump implies something fundamental has changed. The economics must be different now for building and deploying these things. What's driving this sudden scale? Why right now?
Well, it really comes down to the AI engine, specifically these foundation models. They're not just making chatbots smarter. They're tackling the core problem of robot training that used to be incredibly expensive, super specific to just one task.
Right, I remember that. How does a general AI model actually make it cheaper to teach a physical robot a specific task, though?
It's about generalization. Historically, okay, say you wanted a robot to pick up a specific box. You needed tons of expensive data, millions of examples of that box, that lighting. These new models, especially when combined with synthetic data from simulations, let a robot learn general commands, like pick up the nearest object. And then it can adapt to new objects, new situations, without needing months of new real-world data collection. Our sources are saying this has made training something like 10 times cheaper.
10 times cheaper. Okay, that's not just unlocking potential. That's like a structural break. It really could shift robotics from being this niche manufacturing thing to more like a mainstream operational cost. All right, let's dig into this $130 billion wave then. Our mission today, figure out how these three tech giants are playing their hands, because their strategies are incredibly different and what that means for the future of, well, work. Okay, let's kick off with Tesla. They're definitely making the most noise, right? And we have to address that, frankly, audacious claim from their CEO that the Optimus robot, the humanoid, could eventually represent maybe 80% of Tesla's entire value. That just requires immense belief, almost perfect execution.
It really does. But their vision is grounded in a specific economic play that, honestly, no one else is really trying to match right now. It's about crushing the cost curve.
Yeah.
You look at rivals, like Figure, Boston Dynamics. Their humanoids are way over $100,000.
Yeah.
They're shooting for a super aggressive price point, just $20,000 to $30,000 per robot.
Okay, let's pause there. Why is that price point, under $30, so strategically critical? What changes when it gets that low?
Well, everything changes, really. The robot shifts from being this rare, major capital expenditure, something only huge companies could buy in tiny numbers, to a scalable operating expense. Think of it more like, standard high-volume factory equipment. That price makes automation suddenly accessible to way more businesses globally. It just blows the potential market wide open.
Okay, if they're going for that mass market volume play, the sources also flag a pretty big reality check on the execution side, don't they?
Oh, absolutely. Execution is the massive question mark hanging over this whole Optimus project. They set a goal, remember, of producing 5,000 robots in 2025. They apparently only managed a few hundred units. That kind of gap isn't just missing a target, it raises serious doubts.
Hold on, if they missed the 5,000 target by that much, how can anyone take the $20,000 price target seriously right now? Isn't it just marketing hype given where manufacturing actually is?
And that's the core tension, isn't it? It forces you to look really closely at their vertical integration strategy. That's the only way that price point even seems remotely possible down the line. They're making a huge gamble here, basically sacrificing speed and maybe initial refinement for ultimate long-term cost control.
Okay, so break down that vertical integration advantage. How does it actually lower the cost of the parts, the bill of materials?
Well, they don't have to start from zero or buy specialized components from outside vendors for everything. First, they're sharing neural networks, adapting the self-driving AI, FSD, for the Optimus brain.
Right.
Second, they tap into their existing massive-scale EV battery tech and supply chains to power these things.
That makes sense.
And third, maybe the most critical piece, they use their existing gigafactories. They can potentially scale production in volumes that robotics-only startups just. They can't touch that kind of scale. They're engineering this thing for mass production from the get-go.
And there's also that real-world data feedback loop, right? Our sources mentioned them putting Optimus in the employee diner. Seemed like a PR stunt, maybe?
Maybe, partly, but it generated invaluable data. Data on human interaction, navigating messy, dynamic spaces, dealing with unexpected stuff, things you just can't perfectly simulate in the lab.
Hmm.
Yeah, that messy, real-world data is gold. That rapid feedback is essential for iterating the foundation models quickly. Now, for you, the listener, if you happen to glance at the stock price, it's trading at something like 166 times forward earnings, that kind of sky-high multiple. It tells you investors are basically pricing in the successful execution of this future potential, not just the car business today.
Right.
It is the definition of a high-stakes, future-focused bet.
Okay, so that's Tesla's high-stakes gamble on the future, on cost. But if you want to see what large-scale robotics looks like right now, today, we have to pivot to Amazon. They are operating purely in reality. Amazon isn't chasing hype. They run the world's biggest robot fleet, quietly deployed over 1 million units across their network. It's kind of staggering.
That really is the key contrast, isn't it? Tesla's showing prototypes, selling a vision. Amazon is running massive production systems, handling billions of items every day. Their robotics isn't about looking cool. It's purely about unit economics, logistics efficiency on this unbelievable global scale.
And these aren't general-purpose humanoids either. They're highly specialized machines. We're talking about things like Hercules robots lifting, what, 1,250 pounds?
Exactly. Or Proteus units, specifically designed to move safely alongside human workers in the warehouses.
Purpose-built.
Completely purpose-built for their environment. And that combination scale and specificity drives huge immediate efficiency gains. Our sources pointed out their deep fleet system rollout.
Ah, yes, the robot traffic control.
Right. That improved travel efficiency by around 10%.
Okay, 10% might sound modest, maybe. To someone not deep in logistics, why is a 10% gain such a big deal for a company like Amazon?
Because at Amazon's scale, that modest gain compounds like crazy. It can be the difference between getting your package in 2 days or 3 days. Multiply that by billions of shipments a year. When you're processing that kind of volume, even marginal efficiency gains turn into massive, durable competitive advantages. It drives their cost per item down significantly. It's huge.
And this naturally brings up that big public concern, automation just killing jobs. But Amazon's own operations seem to offer a different insight here.
Yeah, the data suggests automation fundamentally shifts the work rather than just wiping it out. Throughput goes way up, obviously, with the robots. But their next-gen fulfillment centers, they don't just cut staff. They change the amount of staff they need. They require way more skilled technicians, maintenance, reliability engineers, data scientists to manage this incredibly sophisticated fleet of over 1 million units.
So it increases demand for higher skilled technical roles.
Exactly. It's a shift in skill requirements.
So while startups are showing off flashy demos, what gives Amazon this durable edge? What stops rivals just copying them?
I think it comes down to discipline and that data flywheel. Amazon's robots are completely integrated into their daily grind. They constantly use the data from their massive proprietary fleet. How long does this battery really last in dusty conditions? Where are the real bottlenecks? How do the neural nets perform when it's hot? They use all that real-world feedback to constantly tune efficiency. This lowers their costs, which lets them invest even more in robotics. Competitors just don't have that volume of operational data. It creates this proprietary earnings loop that's very hard to replicate.
Right. Which brings us to our third titan, Nvidia. They're unique in this trio because they don't actually build the physical robots, do they? Unlike Tesla or Amazon, they're building the software, the chips, basically the brain and the nervous system that makes all this physical AI actually work.
Yeah, they've taken the strategic high ground, you could argue. If Tesla's focus is vertical hardware integration and Amazon's is operational muscle, Nvidia is focused on creating the essential platform, their Isaac toolkit.
Right.
It's rapidly becoming the go-to standard for pretty much every serious robotics program out there.
Okay, let's break down that toolkit for the listener. What are the key pieces that make Isaac so indispensable for the robotics industry?
Well, the sources highlight 3 critical layers. First, you've got Isaac GR00T. Think of this as their large language model, but for physical AI. It's the foundation model that lets humanoids understand general, sort of human-like commands. This drastically cuts down the programming time needed for new tasks.
Okay, so GR00T gives them that generalization ability we talked about earlier with the cost reduction. What's layer 2?
That would be the simulation environment, Isaac Lab and Sim. Look, if training in the real world is 10 times cheaper than it used to be, training in simulation is essentially free. This environment lets developers just rapidly train, test, iterate robot behaviors in a totally risk-free, accelerated virtual world. Before they deploy a single line of code to, a $100,000 piece of hardware, it massively speeds up development for everyone building robots.
Makes sense. And the third piece is about getting that AI brain onto the actual robot itself, right? Deployment.
Precisely. That's Jetson Thor. It's their specialized chip designed specifically to bring really high-end AI inference capabilities right to the edge.
Meaning on the robot.
Yeah, the processing happens instantly, right there on the robot, not miles away in a data center. For physical action, low latency isn't nice to have, it's absolutely critical. Thor delivers the performance needed for a robot to react instantly and safely.
This whole strategy, it feels very familiar. It seems like they're directly using their CUDA playbook, the one that gave them dominance in AI training chips. What makes the Isaac platform potentially just as dominant, just as hard to displace?
It's the same principle. Capture the developers first. By offering the best tools, the best chips, the best simulation platform, they create a standard. And once a standard is set, it's incredibly sticky, very hard to break. By selling the brains, the development tools, the deployment pipelines, Nvidia basically captures value no matter which specific robot hardware design wins out in the end. They're perfectly positioned to take a slice of that whole $130 billion wave.
It's kind of brilliant, really. They supply Isaac to basically everyone who matters. Amazon uses it, Tesla uses it, Boston Dynamics, Agility.
Yep.
They're selling the picks and shovels, betting everyone's going to need to dig for this gold.
Exactly right. And for the investor looking at Nvidia, the stock's already priced for excellence, trading around, 50 times earnings? But the massive upside potential is tied to that platform take rate. If robotics really does scale towards those long-term trillion-dollar forecasts, meaning robots become truly ubiquitous, Nvidia's model of getting a small percentage of every physical AI decision, that could fuel enormous sustained growth, even from where they are now.
Wow. Okay, so this has been a really deep dive into three very different but equally powerful strategies for tapping into this huge $130 billion robotics wave. Just to quickly recap, we've got Tesla betting big on future market dominance through vertical integration, trying to crush the cost curve with that, let's call it $20,000 humanoid gamble, but accepting huge near-term execution risk.
Then you have Amazon, totally focused on present-day operational scale and deep real-world integration. They're leveraging that massive million-plus robot fleet they already have to generate this unmatched data flywheel, optimizing logistics and, interestingly, shifting labor demands towards higher skills.
And finally, Nvidia. Playing the platform game, aiming to control the essential software brain and the simulation tools for the entire industry, positioning themselves as the indispensable enabler no matter who builds the winning robot.
So what does this convergence really mean for you, the listener? I think it signals that the AI revolution is genuinely moving beyond our screens. It's getting physical, entering the world of operations driven by huge strides in industrial scaling, and crucially, that dramatic cost reduction in training and potentially hardware. These three companies, they're not just competing, they're actively building the foundational infrastructure for this next era of physical automation.
Which leads us to our final thought for you to chew on. Think about the long-term implications here. What happens when you potentially have consumer-priced, maybe $20,000 humanoids, backed by a powerful unified training platform like Nvidia's Isaac, and scaled, tested, validated by global operational giants like Amazon? If the training gets cheap enough and the hardware gets affordable enough, what's the very next job, maybe one we haven't even considered yet, that moves rapidly, maybe irrevocably, from human hands to robotic hands? Something to think about.